I would not be talking about crypto today. It's all applicability in the traditional finance space. I would be avoiding talking about crypto. A lot of bankers would say this is all in future. Whatever is coming is PR. Okay, I'm cognizant of that. A lot of segments such as treasury bills, a lot of segments such as remittances, payments have taken blockchain up and readily moving there. Overnight, the volumes are doubling. In some of the sectors, such as trade finance, yes, it's not come as yet. Only the early scales are happening. But certainly in the future of finance infrastructure certainly plays a part there. Uh, I'll just take a check again. Vedant, I hope my screens are moving and you're able to see a white color screen.
Yes, yes, it is.
Okay. So I'll start with a quote from a white paper written by BIS Secretary General, Mr. Augustine Carstens, along with a co-founder of a very big tech company called as Infosys. This was published in April 2024. It was called as Finternet, the financial system of the future. To me, this is nothing but calling, blockchain for finance. So when blockchain or DLT infrastructure is used for financial transactions, they labeled it Finternet. And I would like to read a verbatim line which is put up in the white paper. You can just Google, this is the white paper. Vision of Internet. Using new finance infrastructure, individuals and businesses would be able to transfer any financial asset they like in any amount at any time using any device to anyone else anywhere in the world in a cheap, secure, and near instantaneous way. I would avoid the rest of the paragraph and I would read the underlined one with all relevant laws and regulations. Currently, in some form or the other, some of it is possible, some of it is not possible. Why that is not possible, I would like to go on this particular slide. When the financial transactions started getting made up in the world, okay, again, these are all hypotheses. So let's assume USA started building its financial infrastructure. They built a railway line for movement of, let's say, monies. Then there came a concept of securities. Another infrastructure parallel was built where such securities, capital markets could transact and settlement can happen. Then came other assets, real estate, commodities. Another set of infrastructure was maintained, was created so that people can transact on such assets. Uh, Whenever such transactions happens, it happens over a ledger. Okay, infrastructure is nothing but a ledger. For example, if I have to transfer something to Vedant, okay, a central bank or my bank is maintaining a ledger with central bank. So that particular bank would remove, let's say, $40 from my account and will send instructions, and a ledger where Vedant has his account will be added plus $50. So it's all ledger management. So when the financial infrastructure was being created, it was created in piecemeal. It was created in silos. Many assets, many different ledger get created. Now, taking the same example, if such infrastructure was created in USA, imagine in most of the countries, similar infrastructures were being created. No common standards were being used. And now, when we have to talk to each other, it's kind of a nightmare. Different ledgers, different formats, no common denominators. Okay, it's not so impossible, but it's kind of difficult for one countries to talk to another country from a financial ledger perspective. Okay, the only yes, there are a lot of common denominators. For example, Swift, which is a European government-backed platform, has about 11,000 banks. Primarily, most of the remittances happen over Swift. There are agencies such as Euroclear and a lot of other clearing agencies which are responsible for settlement of securities. But again, these are all piecemeal collaborations which are happening. Imagine if you get an opportunity, world gets an opportunity to build a fresh railway line or a financial infrastructure where, the standards are defined. It is secure. Okay. It does not run on whims and fancies of, let's say, one country. Okay. That is what blockchain is set out to achieve. Okay, if you put up your financial transaction on blockchain, the standards of the blockchain are set pretty much world over. Okay, so when your transaction or when your asset is up there, for someone to buy it, for someone to transact with you, or someone in financial language to talk to you becomes very easy. That is what that is what the funda of blockchain is all about. Can we just all move on to one common infrastructure so that talking to each other becomes easy? You may have your own ledger, okay, in your country. You may have a separate securities ledger. You may have a separate remittance ledger. You may perhaps have 10 different other ledgers for 10 different other purposes, but they all are made using common standards, which is defined in the world of blockchain. And if that financial industry moves there, talking to each other becomes easy. So that's the fundamental behind the world of blockchain. I'll now come into the topic as to, again, as I mentioned, I'm going to be dumbing down all these jargons. Today is all about basics. So again, if you know all the basics, next 50 minutes is not for you. What is blockchain? So I mentioned I'll be using an analogy. Okay, so assume, let me take the chain part of it. Let's assume me, Vedant, Nihar, my colleagues are playing a game, a board game. Whoever wins, okay, one person writes in the book the points that each one of us get. So in case I end up winning, let's say Vedant is the one who's writing. Vedant will write 10 points against my name and 0 against Vedant and 0 against Nihar. Next time Vedant wins, he will write 0 against my name. He will write 10 against his name and 0 against Nihar. What is he doing? He's maintaining a ledger. Blockchain is imagine a chain is so that's the ledger. First of all, understand that that's a ledger. Imagine if I have my notebook, Vedant has its own notebook, and Nihar has his own notebook. Whenever a game gets over, three of us decide that Manish has won. Manish will write 10 points against his name. In my book, I do that recording. Vedant does the same recording in his book. Nihar does the same recording in his book. So what is happening in the latter is nothing but blockchain. And if I write basis a certain page number, and me, Vedant and Nihar decide that on page number 1, on row number 1, we will write the results of the first game. We will write results of the second game in the same page, row number 2. What we are essentially doing is the first transaction is being linked to the second transaction, and the second entry is being linked to the third one. Each one of them are linked to each other. The second one comes after the first one. Okay, it's creating kind of a block that is called as a blockchain. As I mentioned, movement of money, movement of securities is nothing but ledger maintenance. So this is essentially what blockchain is all about. Okay, from an analogy perspective. Okay, cloud versus blockchain. Okay, you would tell the ledgers, Manish, are already maintained on the cloud. Why do you need another ledger in form of a blockchain? Okay, go by the same example which I used earlier. In cloud, Vedant was the one who was using a notebook and writing it. In the latter example, in the blockchain example, each one of us had notebooks and there were rules that people have to agree to whatever we have written. For example, row 1 means you have to write in row 1 itself. Okay, so there are rules. So both the ledgers exist. It's which one makes more sense to you. In financial transactions, you know, dependent on one person, which is Vedant, is too much risky. Okay, that's why blockchain is preferred over cloud. As I mentioned, in the first one, we were dependent on Vedant's notebook. There is one boss. Vedant can do whatever he wants. Yes, that means that three of us will not have to write, which is slightly slow. In the blockchain one, it's decentralized. There is no single boss. We have agreed to a rule. Rules are hard coded. We can't go against each other. It's permanent and secure. If Nihar tries to act fishy and tries to remove the name or tries to misjudge the point, me and Vedant will say, hey, you guys, you are doing something wrong. Look at our notebook. So trust comes in, and trust is inevitably which is needed in finance. That's why blockchain is getting more prominence over cloud in the transaction recording space. Okay, little bit more practical example. This is not a live example. The logos are for representation purposes only. Imagine on the left side a typical commercial paper transaction happening. Okay, this is from India country. Imagine there's a depository, there's a registrar and transfer agent, K Fintech. There's a rating agency, there's an IPA, which is a bank, there's an investor, then there's a exchange where the commercial paper gets listed, then there's a clearing agency. Currently, and of course, there's the issuer, commercial paper issuer. Everyone has their own ledger. They don't talk to each other on a single platform. Okay, they all maintain their own ledger. Imagine if this commercial paper transaction where over 5 parties are involved and they operate in a completely disjointed manner, if they operate in a single source of truth manner, which is blockchain, things will become easy. Of course, it's not as easier said than done. It's common sense. But on the left-hand side, it's time tested. It cannot go wrong. From the left to right, it's a phase. It's going to take some time. And that movement is happening as we speak world over. This is an extract from the Finternet white paper. Uh, I talked about this common infrastructure. Decades and decades and centuries of, efforts have gone to create the current infrastructure which works. Okay. And our current infrastructure works. When I have to send money, billions of dollars or millions of dollars, I know it's going to get there. Okay. For this infrastructure to move to below, it's not going to be easy. Okay. It's going to be a step-by-step approach. Okay. This is what Finternet, the white paper, mentions, and initiatives towards this have already started. Okay. It's not a concept. Okay. Movement towards this has already started. In the subsequent slides, I will be mentioning about that as well. What this Finternet paper says it, you have your traditional infrastructure. Okay. You would be having your digital wallet. You'll be having apps. There'll be banks. There'll be private companies. There'll be asset management companies. All of them are on ledgers. What they are saying is the first thing is try to first of all adopt the blockchain systems. Okay, you need not adopt blockchain ledgers, which are, let's say, created by someone private. Okay, try to get onto some or the other ledger. Okay, or your existing ledger on ramp to a single ledger, which is golden ledger. Okay, golden ledger can be a government initiative. Again, can be a public chain. It can be multiple central banks across the world can come again and create this. By the way, this golden ledger, there's RLN in Europe, which is happening, regulated liability network. They are trying to create. MAS is working with about 15 to 20 central banks to create something like this. Okay, a golden ledger. And that golden ledger will give you an opportunity that in case you want to get onto a new infrastructure, just on-ramp your current ledger and to this golden ledger. You can carry on your activities the traditional way, but if you want to get on the new railway line, the new infrastructure, okay, just via APIs or via some hook, get onto that golden ledger so that whenever you want to transact, in a very convenient manner and basis the vision of Internet, which is this. Okay, on ramp your ledger into the current one so that you can get onto the future of finance infrastructure. Okay, this way is slightly more preferred way because it's not telling people to get rid of their traditional infrastructure. What they are saying is just try to on ramp to a single golden ledger. Okay, imagine again one more transaction I showed about commercial paper, how disjointed it is, and in future how it can be. Imagine this is a remittance. On the top section of the PPT slide, about 12 steps even now are required for Maria to buy a equity share, pay for it, and get that equity share in her account. Possibly in future, it may be just a set of 2-3 steps. First step would be manual, rest all will be automated. Why? Because blockchain uses something called a smart contract. Again, a jargon. I will try to explain you something, what smart contract is in the later slides. But you triggering an action, that also you cannot trigger. You can just say, if the equity shares is 80, buy. If it happens in the current world, there'll be set of 12 different hops. But in the current one, it will be just 2 or 3 hops. Okay. So the movement of money also will be automatically settled. Okay. I will talk about more about smart contract in the subsequent slide. But this slide is just to prove you the number of hops reduction, which will happen when the capital markets move to blockchain infrastructure. I was attending a global fintech fest last year where major CTOs of various central banks, various innovation hubs, various registries, okay, which clears billions and billions worth of securities were there. They had evaluated blockchain and DLT infrastructure for around 2 years. And this is what they said. What they love about blockchain is the chain of blocks, meaning the row number 2 cannot become row number 1. Each transaction is linked to each other. And that's the basis thesis of Ledger. Ledger has to be date-wise and transactions have to be linked to each other. Cryptography, which is a very, very high secure feature, is basic core to blockchain. Okay. It's not that you need a backup policy. It's core to blockchain. No block deletion allowed. Going by the example, Vedant cannot delete anything, Nihar cannot delete anything, Manish cannot delete anything. Okay, the coding is done in such a manner that nobody can, once published, it's published. You cannot erase it. Automated backups are inherent architecture of blockchain. If Nihar does something to his notebook, automatically Vedant and Manish's notebook are there any which ways. And tomorrow, my notebook will override Nihar's notebook so that Nihar cannot do mischief around the transactions. That is also inherent part of the architecture of blockchain. Owner of infra can be all participants. Going by the same example, I own my notebook, which is called as a node on the blockchain. Vedant owns his notebook. Nihar owns his own notebook. It's not cloud driven that one company will own the cloud and will be the boss. Okay. So again, these are not my words. These are words of the CTOs of influential companies. But of course, if you want to move large amounts of data, blockchain is not for that. Perhaps cloud is for that. Public chains are cheaper than the cloud. Private chains may be costlier, but if financial infrastructure is using public chains, it will be in a way long run out to be cheaper than even the cloud infrastructure. If you are using a private blockchain, again, what is public blockchain, private blockchain? Public blockchain means anyone can hop on and download a wallet such as MetaMask and can start transacting on the blockchain. Private blockchain is restricted participants. Only when your wallet gets a allowance or let's say a permission, can you log on to that blockchain and start doing the transactions. That's the difference between the two. Private chains, if volumes and number of participants are high, private chains still would be cost effective. But if it's less number of participants, very low volume projected, private chains would turn out to be costly. So these are some of the characteristics, and this is the milestone that any banker, anyone in BFSI domain should use, whether they should use blockchain or they should use cloud. Some more points. Again, 6 months back, people will ask me, how is it possible? Okay, come August 2025, cross-border settlement. Of course, everybody knows blockchain is fairly effective. In countries in Africa, okay, local retail payments, left, right, center are being done using digital wallets. This is personally closer to me. The second point, which I mentioned here, there are capital deficit countries, there are capital surplus countries. The movement of capital from surplus countries to deficit countries currently are disjointed. It takes a lot of efforts, and the movement of capital costs a lot. My personal belief is once this financial infrastructure is set up, okay, a reality in that excess capital coming to deficit capital countries so that they can earn little bit higher yield would happen more and more. Thus, new financial infrastructure is good for bottom of the pyramid, MSMEs, people who do not have access to formal credits. Capital markets, we all are aware. Okay, in the end, I would request Vedant to talk about some use cases around capital markets, and he will actually show you where all blockchain is used in capital markets. But I'm sure you guys are by now aware where all in blockchain is being deployed in capital markets. Uh, Again, world is full of ecosystems and consortium. Okay, currently, as I mentioned, there is no common denominator. Okay, if at all world has to become barrierless, or let's say one scale of the world, I'm aware that West is emerging as a new polar. China-led consortium would be another polar. Okay, but within that ecosystems, if you need a barrierless world or barrierless trade, okay, adopting this financial infrastructure would be the key, and which is what is happening right now. Web3 ID, KYC, KYB is very local, very domestic. Okay, yes, I'm aware LEI, again, legal entity identification number project is on, but if it has to scale, it would need a common denominator, and which is something called as a, it can be attached to something called as a Web3 ID. So tomorrow, if somebody has to hop onto this new financial infrastructure, he or she can hop off using the Web3 ID, which is interoperable across the world. Currently, if I have to buy equity shares in India, I will need a demat account here. If I need to buy in US, I would need another demat account with that there. Likewise, in each of the countries. Okay, this is friction. Okay, in case in future, okay, we are looking at barrierless trade. Okay, imagine this common single railway line, one digital wallet, okay, which has a verified Web3 ID recognized in all the countries. I can just use one wallet to transact a lot of currencies, lot of securities of various countries. Okay, just doing a time check. It's around 4:28. I'll try to move a bit faster. Okay, this we are all aware. This was our projection last year. Okay, in fact, 2 years back, me, Vedant, Nihar, we made this. This was our projection. We used a white paper and we superseded that white paper with our projection. Currently, what is happening is going as per the plan. Okay, we are already seeing early scale coming in this future of finance infrastructure. By mid to late 2026, our vision is that things will just explode, which is adoption of this future of finance infrastructure. Stable coins. Let me just explain first what are stable coins, then perhaps I would come there. Okay, what are stable coins? What are CBDCs and what are deposit tokens? So earlier, I mean, back when stable coins were evolving, I remember about when I dived onto this industry. So I joined this industry about 3.5 years back. When I hopped onto this industry, there used to be algorithmic stable coins. Okay, basis algorithm, those stable coins used to get minted and you used to get transferred. Okay, they did not have any underlying and they were just purely code driven. Okay, there were chances of fraud, happening because there was no real world representation of that stable coin. At the moment, you would be hearing about fiat backed stable coin or not. Most of the banks, most of the central banks in developed world are on the verge of adopting or have already adopted fiat-backed stable coins. Okay, they have given or on the verge of giving some sort of sanctity to fiat-backed stable coins. What it essentially means is a regulated entity can put up, let's say, $100 in a custody bank account. That would give them the power to mint or put 100 tokens or 100 stable coins, $100 worth of stable coins on the blockchain. When you are on the blockchain, you need a digital currency. If you keep on interacting with the fiat, the friction will come in. You need a currency which moves on the blockchain, which is where, a digital currency is required. So that one such fiat-backed stable coin is USDC. USDT, it's written algorithmic. It should be fiat. Okay, these are the two top stable coins. Apologies for this error, which are USDC is fiat backed. Tether, I think, is securities backed. I can check that again. Paxos has a stable coin called as PaxG, which is backed by commodity, majorly gold. So there is a fundamental physical asset lying somewhere, which gives credibility to this stable coin. That's so a representation of a physical or a money kept somewhere on the blockchain is called as a stable coin. A representation of your current account on blockchain is called as a deposit token. Okay. A new currency, freshly mint with no representation, mint by a central bank of any country on blockchain or on any other equivalent infrastructure is called as central bank digital currency. That's the fundamental difference between stablecoin, deposit tokens, and CBDC. I'll repeat again. A digital currency published on chain, which is backed by some asset. It can be backed by gold. It can be backed by physical dollars kept somewhere. It can be, by the way, backed by some set of codes as well. It can be crypto backed as well. When it's backed by something underlying derivative and it's issued by a private regulated entity, that's called as a stable coin. Okay, it's not a fresh currency. It's basically backed by something. Deposit token is nothing but a mirror representation of your current account. So for example, if I have $100 in my Bank of America current account, I can just say out of 150, I want a representation or equal representation of that 50 on blockchain. So what Bank of America does it, again, hypothetically, if they are part of a deposit token network, and if they allow deposit tokens, they will put 50 on that deposit token network. MasterCard deposit token is a very famous network. By the way, we at Vyana, we've developed something called as Vyana Debt Platform, where we have settlement layers as MasterCard Deposit Token Network as well. So there we use USDC for loans as well. We use MasterCard Deposit Tokens to settle when movement of money from one wealth investor happens to a borrower. More about you can find at vyana.com. Click on a menu called as blockchain. So coming back here, so that's deposit token. CBDC, again, central bank publishes a fresh currency on chain or equal infrastructure, which is a digital currency. That's called as a central bank digital currency. Okay. Whatever I've put up here, okay, is relevant for CBDC and relevant for all, most of the digital currencies. For example, atomic settlements. Okay. Now take an example, equity shares. If you buy equity shares, money from your account gets blocked. Typically, the money gets moved earlier, then your demat account gets hit with your security later. Okay. There is no proper handshake between settlement of money and settlement of security. In digital currency, because the security and the money moves on the same railway line, same infrastructure, it can be a handshake. Asset is coming in and the money goes out parallelly at the same time. If the asset is not credited, the money also will not be credited. That's called as atomic settlements. Programmability. Money in the current world cannot be programmed. Okay, you have to build layers of services over over the money to program it. For example, if I've given loan to Vedant, okay, I can send that loan with a program saying that Vedant cannot use that loan which I've given to him to buy liquor. Okay, I can put up a program saying that Vedant, this money is given to you, but automatically the EMIs, which is every month and 30 days, the interest will be auto debited. Your wallet will be debited and equal amount of digital currency will come in and reside in my wallet. I can do a lot of programming around this. In India, there's an experiment happening where the bottom pyramid people, they get certain subsidies from the government for buying their local ration and all. Government is trying to give them CBDCs as against normal money so that they can't misutilize that. And that CBDCs are restricted to be used in certain merchant shops so that only ration can be bought. Okay. So a lot of such things are happening. Okay. Costs, of course, the underlying, if it's a public blockchain, you don't require to set up your own infrastructure or even your private blockchain. The standards are set. for you to talk to countries becomes easier. The cost using a digital currency is low. Again, the CBDC is appearing, but what I'm talking about is very well applicable to all the three digital currencies: stable coins, deposit tokens, and CBDCs. Interoperability. Okay. I don't require those complex switches. Okay. I can code smart contracts on the chain which can act as a treasurer, or they can have pools where somebody deposits US dollar stable coin, somebody deposits GBP stable coins, and there's an interchange. I will talk about more smart contracts later, but assume that all of this can happen just using piece of codes. Okay, no such complex infrastructure required when you move on to DLT based infrastructure. Less intermediation, less fraud. Of course, it goes without saying. Because everyone is on the common infrastructure, room for intermediaries is less. Okay. Let me now move on to the, So smart contract. I was talking about this. In fact, before this, let me just take a small break and ask Vedant if there are questions put up which we can answer.
Yeah, sure. So there is one question. So basically, blockchain basically relies on each person or node maintaining the complete block details right from inception. As we grow with the blockchain, will this lead to an enormous amount of data required by each node, eventually slowing down the blockchain processing and replication?
So maybe Vedant, you want to take this up
Yeah,
and you want to
yeah,
give
sure.
a scale as to the trillions of dollars or the data which is already on the blockchain, if you can give that context.
So basically, on blockchain, you do not upload very data intensive or storage intensive files like images or videos. It's just transactional information which goes on the blockchain. So that takes very limited amount of storage space. But still, because everyone will be using that, storage will also become enormous and will require very high processing power and other capabilities. So there are people working on different techniques like sharding and other technical stuff to basically make these nodes lighter, as well as allow faster processing speeds. So innovation is happening in this space. Definitely, this is a problem which needs to be tackled, but with time, this will also be solved.
And one more thing I wanted to add to what Vedant said. Every transaction that you record on a chain, you have to pay a very, very small cent, very small gas fees. It's called as gas fees. Okay. It's nothing but typically when you transact with a bank, you would be charged something, right? It's not what bank charges. It's very, very small portion of it. These chains also, that's a mode of earning for them as well. Okay, they use that, and they would be ensuring that as and when the scale happens, they would be deploying and the infrastructure is ready for it. Okay, so just wanted to add to what Vedant said. Yeah, Vedant, any more questions? Hello.
No, none as of now.
Okay, so let's quickly move on to, I
Yeah,
was
no
mentioning,
more questions right now.
got it. Let's quickly move on to smart contract. Am I audible, Vedant?
Yes, yes, you are.
Okay. I was mentioning smart contract again and again. Okay. If you are on cloud, okay, if you're using your phone, what you do is you download an app. Okay. That app belongs to a company. Okay. You would be downloading an Apple app, you would download a Google app. If you're using an AI Perplexity, you would download a Perplexity app. Okay. When you want to deploy, so for example, let me show you our package. This is what we have developed for banks and for fintechs, and we've just deployed it in Europe. Okay, so Vana Debt Platform. This is a B2B credit stack which we have developed, which can be deployed on blockchain. When I have to do this, 1 second, PPT, yeah. Vedant, my screen is visible.
Yes, Manish.
Yeah. When I have to deploy my stack on the blockchain, I build it as smart contracts, set of smart contracts, and I deploy that. I don't deploy an app on chain. I deploy a set of smart contracts. Okay. Uh, In a way, it's that. So you see the differentiation. As I mentioned, when you have an app, it's usually private. But when I have deployed it on a public blockchain, that code is visible. Okay. But it's not changeable. Okay. Overnight, Apple or something can take the app down, and change it as well. But when I deploy on the code to take it down, it's a bit of effort. Okay, I cannot, even if I take the smart contracts down, I cannot take those transactions which are recorded already down. Those transactions are recorded and for the history will stay there. So tomorrow, if somebody still wants to use that, they can still go ahead and use it. But when an app goes, you try deleting an app on your phone, the data also of that app particular goes with you. Okay, so it's very clear. When I use an app, I'm relying on a single central party. Okay, I cannot have common infrastructure, central infrastructure, when I have one company running everything, which is where smart contracts are proving to be boon. It's written using language called as Solidity. Some of the chain use language called as Rust. My colleague here, Vedant, who's a coder, in later on can answer certain questions around how different it is from JavaScript, etc. I have seen some chains using Python as well. Okay, using the languages. So that's what smart contract are. So in the world of blockchain, when somebody tells you what smart contract is, please just don't assume it's something very technical and all. It is nothing but a app version. What in a cloud, what you call an app, it's nothing, it's something similar. Okay. Now coming to a very important topic, tokenization. Okay, this is the prediction by Citibank that corporate debt, okay, tokenized, would be 1.9 trillion. Trade finance would be 1 trillion tokenized, transactions you would see by 2030. All of us are aware what is demat. Okay, do not make it complicated. Tokenization is nothing but demat on steroids. I would tell you what steroids represent. But whenever somebody tells you what is tokenization, the tokenization will do that, etc. Okay, in your mind, always remember, okay, what is demat? Tokenization is some sort of an advanced version of demat. Okay, in a technical definition is tokenization is process of representing an asset digitally. It can either be a digital representation of an existing asset, or you can have an asset directly put up on the blockchain itself. Okay, so when I say demat on steroid means, currently if you get equity shares, can you program that equity shares? You can't. You can program your broking account, which will instruct or act on digital shares. So for example, uh, when I'm transacting with Vedant, okay, I'm sending a equity share to Vedant via blockchain, a tokenized equity share. That tokenized equity share will be programmed in such a way that it checks, is Vedant listed somewhere in blacklist? Okay, is Vedant's KYC, KYB proper? Okay, I can, give it a lot of commands. Whenever this transfer happens, this particular tokenized equity share should send an instruction in the common ledger, updating the ownership to Vedant from Manish. So I can program that tokenized instrument. At the moment, I can't do all that using demat equity shares. Okay, I have to build layers of functions which will do all of this. Okay, so programmability. Okay, if you are able to program your asset, that is what tokenization is. Tokenization is nothing else. That's the difference between demat and tokenization. We've covered this. So in the interest of time, this is a complex transaction. Again, I don't want to deal anything complex. I just wanted to show how securitization using DLT would be in future, but I would keep this for the next time because we want to keep it very simple this time. I would request now Vedant to take over. I would continue sharing my screen. Vedant, you can tell me.
Yeah,
I would mute myself and over to you to take over this part of presentation. We have about, it's 4:46. You can go on
sure.
for 10 minutes, then we can have 5 minutes of Q&A.
Great. Thanks a lot, Manish. So, guys, let's hop around the globe for an update on how countries are making or breaking the history in this industry. So,
Vedant,
I'll
if you can
talk.
speak a bit louder, please.
Oh, sorry. Yeah. So I was just saying, so let's go around the globe and see what different countries are doing in this particular space. So let's start with the United States. So it has gone from the Wild West to a homeowners association. So they passed the Genius Act earlier this month, and it's a first major milestone in the stablecoin law. So only banks and tightly approved companies can now issue stablecoins, and each stablecoin must be backed dollar for dollar against cash reserves or treasury bills. So no more funny business. Companies can face monthly audits. They can't use the payment information for any marketing purposes, and they have to respect the privacy more than ever before. By 2028, all non-compliant players will be out of the market, and uh, this particular stable coin is actually going to become a tool for the American finance. So the US government will be able to sell bonds using stable coins, and that's where the market is going towards. For the retail CBDC bit, the US Congress has slammed the door shut. Uh, they're now racing towards finding clarity of who sets the rules for the next wave of the tokenized real world asset market. Moving on to the European Union, so they have built a digital fortress. So they have the MiCA law, which is active in more than 27 countries. And if you want to run any crypto tokenization or digital assets business in the EU, you need a MiCA license for that. Uh, Again, everything is regulated. There is surprise audit checks. There is stress test for the companies, and no risky tokens or flashy marketing is allowed. And Europe is not just thinking about coins. They are experimenting with selling bonds, mutual funds, government securities, everything on chain for the first time. And there is also digital euro pilots which are happening in the EU space. Then Hong Kong is aiming to become Asia's digital asset superhighway in a way. So from 1st August, all the companies who want to deal in this particular industry will have to get a very hard to get license. So everyone will need a license to operate if they want to issue stable coins or tokenized securities or even NFTs. Uh, so these rules cover almost every different kind of industry, from exchanges to custody players to smart contract platforms, everyone. And if you are unlicensed, you are out. And if you comply with all the regulations which Hong Kong has come up with, you get access to trillions flowing between China and the rest of the world, making Hong Kong a true crypto and tokenization bridge between China and the world. Then there is Japan. So Japan does it the classic way. They have bank level security at the helm, and they're quietly innovating very many different things. So they have also created a license where banks and other parties can get the respective licenses to issue tokenized deposits as well as stable coins. They also have a sandbox setup where they are allowing firms to issue tokenized versions of equity and debt, and within the purview of the sandbox. And they're also partnering with many different global players. Then finally, Middle East. So Middle East has has not just joined the race; they are actually building the world's strongest tracks. So UAE's ADGM is famous for its quick and clear rules. In 2025, they have fast-tracked approvals for launching many different digital token projects, whether it's tokenized stocks, property, crypto trading, etc. And they've also made different innovations where they've allowed stable coins or digital currencies to be used for different payment purposes like court fees as well. Then there's Dubai's DIFC and Vara. So they mix sandboxes and licenses, and you can test out different tokenized products in that sandbox. And once they pass and graduate, you can take it around the world in the particular regulatory oversight. And they're also working on different Web3 based ideas to lay down the future blockchain regulations. Then Qatar has gone big on the real world asset tokenization space. No speculative tokenization is allowed. Only real world asset tokenization, which includes real estate, commodities, equity, debt, and other asset classes which hold real value. Only that is allowed. And they've also given clear guidelines to all the courts to handle disputes. So basically, in short, 2025 has been the year where blockchain, tokenization, crypto, and other digital assets have stopped being the Wild West and started looking towards tomorrow's Wall Street. So I'll quickly go through the different use cases which we have been working on, as well as what's happening around the market. So there's securities tokenization. So Manish has talked about it a lot. The tokenized version of equity or debt. So that is the securities tokenization. Then we have lending using digital currencies. So currently, you get loans using fiat currencies. Now, on with blockchain, we can have stable coins, CBDCs, and other forms of digital currencies used for settlements of loans. Then we can have wealth and asset management use cases. So JP Morgan has built a complete suite for their wealth management purpose. Similarly, SG Forge is another one by Society General. And then Citibank has also launched their own suite of digital asset called SideApp. Then there's tokenization of commercial papers. I think Manish talked about it briefly. So this is also a use case. Then we are also working on another use case called the deep tier financing, where currently the uh, traditional supply chain finance market is restricted only to the tier one supplier. But using blockchain technology, we can actually link the whole deep supply chain and create or establish a relationship between, let's say, a fifth tier supplier to the main large anchor buyer, and allow the lower tier suppliers, which are primarily SMEs, to avail cheaper credit using the banking ecosystem. This is just a flow diagram, and in future we'll also be having another session on this. And finally, the MLETR, or Model Law of Electronic Transferable Records. So this is a law put forward by the United Nations body. So to tokenize cross-border trade documents. So next week we are having an extensive session on this particular use case, where we'll be going very deep into what it is, what are the problems it is solving, and how we are solving it. So probably you can join in for that session and get more details.
Yeah, I think so. We'll stop sharing, and we are bang on time. Let's take, I think there are a couple of questions. So Vedant, let's take those. And
Yeah,
by the
sure.
way, the
So
session is being recorded. So eventually, whoever has registered for this session, they will get an email with the recording link. So in case you want to go through that, you'll be able to go through that as well. Yeah, over to you, Vedant.
so there's one more question asking. So you mentioned fiat is difficult to move on blockchain. So it has to be converted to CBDC for a country to push its fiat.
So my view here is fiat and CBDCs are different. You cannot convert fiat to a CBDC. CBDC itself is a fresh new currency which you issue on a technology such as blockchain. Some of the countries do not rely on blockchain, some do. Okay, so you cannot have fiat converted. Okay, what you can do with fiat is what Circle is doing. They keep fiat with Boni, with few other banks, which are deployed on, let's say, fixed deposits or treasury bills. On back of that, they release stable coins. So using fiat, you can, with the best of my knowledge, move it to stable coins. And you need a digital currency which will move, which is programmable, where you can do a lot of things on that common railway line, which is blockchain. That's why fiat would lead to a lot of friction. And the moment you have fiat settlement layers, the laws, the physics, I call it physics law of the traditional finance would come into the play. Movement of money from, let's say, me to Vedant, who may be in some emerging countries, would take 2 days. It would take about 30 seconds if I was on blockchain. That's the reason, fiat brings in encryption and you cannot convert. You rather move on to a CBDC.
There are no more questions right now, guys. In case you have any questions, you can post it on the Q&A tab or the chat window. Anywhere is fine.
Otherwise, thank you so much. Thank you for joining us from various parts of the world that you have joined in. Once again, one more request, as we've been mentioning, Vedant and Nihar would be hosting a session on M-Letter on 7th of August, Vedant, right? And
Yes.
look out for the announcement around real estate tokenization, around tokenization for capital markets, equity share tokenization, AI part two, blockchain part two. So several other seminars webinars coming at your way. Thank you so much. Have a great day ahead, guys.
Thank you.
Thank you.
Thank you.